Hey everybody, Brian Shannon from Alphatrends.net. Today is Friday, the 29th of September, and a pretty ugly month for the most part, except for energy and Bitcoin, which were higher. The equities, though, SPY down 5% for the month, led lower, of course, by the semiconductors. That's why we watch those so closely. And bonds were down 8% on the month. They're now down 23% from their high for the year. The biotech's off close to 27% from their high. Semiconductors down 11% but from their high, but still up 44% for the year. So let's take a look at the charts and make some sense of it here. This is the daily chart on the left and the 30-minute time frame on the right. And what we have here is that anchored volume weighted average price that we've had our eye on from the March low. We closed above that for the week and pretty much every day here. We came down and tested it, but as I mentioned on Wednesday, that didn't make it a buy in that area. I always say there were a level of interest because had you purchased it there, you would have had to withstand a couple points of downside. Looking over here on the right, on Wednesday I said really what I'd like to see is if we hold above the anchored volume weighted average price from the low, and we're pretty much right on that. We still have a declining 5-day moving average. On Monday, that 5-day moving average will continue to decline as we get rid of this data from this past Monday. And we just remain kind of a mess. I had mentioned the possibility of a scenario here that could mean further upside here maybe in the next week or two, but then a possibility that we come down all the way to the anchored volume weighted average price from the beginning of the year. That's that blue line. That's also exactly where we see that 200-day moving average. And when we back it up a little bit here and put Fibonacci off of the low of 22 to the high of 2023, you can see that's pretty much in that same area as well. A little bit below it at 417-ish, whereas this is really about 419, 420 for those of you who get excited about that weed number. Anyways, the path of least resistance in the intermediate term is maybe starting to turn a little bit more neutral, but I'm not convinced yet. I have been just very aggressive in terms of my time of hold in here and in terms of the amount of size that I'm trading. I've kept everything pretty low in here because we've been choppy. I mean, look at today. We gapped up and completely failed. We gave up that entire gain, and when we look at the weekly chart, we're right down, as we mentioned, to that anchored VWAP from the March low. It's just an ugly looking market in the intermediate term. They say the fourth quarter is supposed to be positive. We'll see. I don't see anything here that would indicate we're ready for an uptrend, but let's see if these markets can rebuild and then maybe prove themselves a little bit. The NASDAQ came right up to the anchored volume weighted average price from the high earlier this month right here, and that's where it got rejected. You can see the 5-day moving average is just flattened out. That's because that last candle of the day, last bar, we got rid of this and replaced it with that. So it's actually rising ever so slightly. You can see 356.96, 356.94, and then 56.95. So that last candle bar brought it up 1 penny. But over to the bigger picture, this anchored VWAP from the April low rather failed. It was from this low where we found some buyers. I still think there's a greater possibility that this whole thing can kind of fall apart. And while we have the 5-day moving average just flattening out and beginning to turn higher, we have a lot of potential for overhead supply in this market. Now, I know everyone wants to see this gap get filled, but don't forget, this gap still hasn't been filled completely, if I am reading that correctly. And this gap hasn't get filled. Not all gaps get filled, not immediately at least. So NASDAQ remains vulnerable, maybe a little bit better shape. What I'd really like to see, I think, here is a little bit of a pullback, kind of shake out and then rebuild for a push higher. Then we've got to take it one step at a time. Will it find supply there? If it does, maybe it consolidates a little bit, then rallies up to the anchored VWAP from not only the beginning of the September, but that high that's there as well. And you can see that's right here. We have a declining 20 and 50-day moving average. It's difficult for the market to sustain rallies with a declining 20 and 50-day moving average, not only here in the NASDAQ, but right here in the S&P 500, declining 20 and declining 50. This is where we were 50 days ago. So all next week, we'll be getting rid of that data and replacing it. Even if it's with data up here, it means those will continue to decline. Same with the 20-day moving average. So if we get a rally and that's a possible place where we might see some supply. Over to the Russell 2000, there's just been no reason to buy this group. It remains just ugly. Bigger picture, weekly time frame, this is the bigger range that we're in. If you're into trading ranges, then this is your market. I like sustainable trends. And as we noted a couple months ago, this was the era to become cautious, not to look for the breakout, because it had expended a lot of energy getting there. We broke below the 200-day moving average. That's still now declining in here. We're below declining 20 and declining 50. If you're trading these rallies in here, know what you're doing. You're trading for a bounce within a primary downtrend. The semiconductors got a little rally up, and let's just talk about this for a moment before I delete all these lines in here. What we've previously spoken about was this is a double-headed head and shoulders pattern, and this being the neckline right in here. So let's delete all that stuff off there so we can look at this a little bit more objectively. The anchored volume weighted average price from this high, which I have colored red here, is actually this right here, that black. We're back above that. That's good to see, but we're approaching that declining 20-day moving average. We've got the anchored volume weighted average price from the September high just overhead, and it is kind of ugly. What a bearish scenario would look like is we break the neckline, we see a return to the neckline, and then roll over. Now, we don't have the evidence of that yet on the shorter term time frame. What we're looking at over here is, that 5-day moving average should continue to rise for a couple days as we get rid of this data, 2-3 days. So if we start to distribute here and then break back down below that 5-day moving average, let's say, Thursday, Wednesday of next week, then we could be setting up for a bigger decline down towards the year-to-date anchored VWAP. I really don't see the case for a low-risk, high-probability long trade in these markets, so I think the best course of action is just to continue to be quite cautious in here. The biotechs, as we know, have been the worst group here. They undercut that prior low and for one day and then bounce back up, and they're trapping the people who had their stops underneath there, trapping the new shorts who woke up and decided it was in a downtrend. But there's nothing bullish going on in here. Just because we're above that doesn't mean that we're bullish. Just because the 5-day moving average is flattened out doesn't mean we're bullish, because we have a declining 20, 50, 200, 100, 150-day moving average. I think this market's a waste of time. I don't even know why I'm talking about it. Financials also having trouble with the anchored volume weighted average price from the March low. They tried to rally, but with that declining 5-day moving average, they're still guilty until proven innocent. We're back below the volume weighted average price from the low it made this week. That means the average long from that point, who was feeling good about it for a day or two, is now feeling badly. They're losing money. The shorts who pressed their position into that rally, they're feeling good. They're in control. So the financial stocks, let's take a quick look at that weekly time frame. I just don't see anything really very much of interest in there. Let's talk about bonds for a moment while we've got this weekly time frame up. We broke this prior low from 2022, and we've got to go back pretty far to find lows that we've been here. So this is 2011 since we've had these types of bond prices, and even there, when we look at the lows in here, did we undercut that? We're pretty much right on the lows from 2010, so 13 years ago. That's how bad this has been. And I still get people asking me, hey, do these things look like a buy yet? And I don't know what they look like, what a buy looks like when a stock or a market is in a downtrend. We're below declining 20, 50, 100, 200-day moving average. Yeah, we'll get bounces, but don't waste your time buying garbage like these bonds. They're in a downtrend. Just leave them alone. Let people who like to lose their money buy it. The energy names came into a little bit of a trouble here, and we saw that oil backed off a little bit, but still just a couple percentage points off of its high for the year. Apple came down very close to where it was supposed to. So as we were talking about, it was dancing on the anchored VWAP from that March low right there. And I was talking about how we had a lower high, another lower high, and more frequent tests of that support typically means it's going to break down and go test the next level. There's nothing bullish about Apple that I can see here. We've got a declining 20 and 50-day moving average. If they don't scare you out, they'll wear you out. It's going to have to get back above 175 just to become neutral. Otherwise, it's guilty till proven innocent, like so many of these stocks. If you like the video, give it a like, make a comment, share it with your friends. Thanks for tuning in. I'll talk to you next week.